Hey there, a little context before we hop into this episode. I recorded this as a webinar with Howard Halderman of Halderman Real Estate and Farm Management. They quarterly release a Maximize Your Farmland series of webinar. I was the co-host, interviewer, and guest, if you will, and I thought this is information that's so compelling, I want to share it with you as a Business of Agriculture podcast. The topic is agricultural real estate at a peak. You're going to like this conversation. Hey, Damian Mason here with a question before we hop into this episode of the Business of Agriculture. If you farm for a living, you employ a lot of amazing technology, from your inputs that you put into the soil to the tractor that you sit in, your combine, and the amazing data that it harvests. But has your soil analytics kept up technologically with everything else in your farming operation? I would venture to say that no, it is not. Sure, you check for your nitrogen, your phosphorus, your potassium, your micronutrients as well. But what about disease pressure? Do you know what diseases and what pests you're going to face next year? No, you don't. But you can now figure that out with Pattern Ag's predictive analytics. Think about it. They can tell you now with testing what the likelihood of facing nasty diseases, things like cyst nematode or sudden death syndrome, what the likelihood of you having this in your field, then you know how to prepare, how to treat, and where to invest your money. It's using technology to make you bigger yields and therefore make you bigger money. Go to www.pattern.ag to learn more. They are pioneering the way in predictive agronomy. All right. Thanks a lot, Mr. Halderman. As Howard said, I produce the Business of Agriculture podcast. I speak at agricultural events all over North America. I am coming at you from a condo hotel, if you will, near Lake Louise, Alberta, a couple hours west of Calgary, talking to the International Egg Commission here tomorrow morning, and I've got some engagements with them yet this afternoon. So we're going to go to eggs after we talk about farmland real estate. We're also going to release this as one of my Business of Agriculture podcasts. So this is kind of cool. Howard's been on twice over the years. I've produced about 310 episodes. It's been going for 6.5 years as both an video and an audio. So we're going to release this as one of my podcasts because I love these topics. And that's why Howard and I got together. We said, let's conduct this kind of as an interview format because he always has to carry the water on his webinars. I said, how about if now I'm asking you the questions and we just let you delve into your expertise. And what I'm really ecstatic about is the experience. As he just said, I get the Halderman emails, you get the Halderman emails. There have been a boatload of sales here recently, some very large ones also, which I think are going to be a bellwether and indicative of what's going on in the marketplace. So we beg the question, is ag real estate at a peak? That's where we're going to start. Howard Halderman, is ag real estate at a peak? It's hard to argue that it's not at a high. In both nominal and real dollars, we're just about as high as we've ever been. Yes. And then If it's a peak, and then the question is, if it's at a peak, does that mean we're going to start going down, or is it peaking just for now? Because there's people that when the stock market, when the Dow Jones was at 10,000, they said it's at a peak. Well, here we are at 34,000. So is ag real estate at a peak? And then what does it mean?
It's been interesting, Damian, since 2021, halfway through the year of 2021, we saw that farmland we always knew was a hedge against inflation. But for, a couple of decades, it never reacted because there wasn't any inflation. Then all of a sudden, with all this stimulus, we have inflation again. And farmland went up 40% in 2021 based upon our metrics. And we are. Arguably, and I think the data will show it, we're at the all-time high of farmland values from a real and nominal standpoint. So at a peak, yes. Where we go from here is the big question. And I would argue that interest rates, higher interest rates, the Fed had a desire to cool the economy, right? Mm-hmm. And I think with interest rates in the housing market as well as in the ag space, it's having their desired effect. So you've got interest rates that are in that 7-8% range versus 3% 2 years ago. So the cost of borrowing money is much higher than what it was. In addition, we're looking at corn prices off the combine, if you were to start harvesting tomorrow, that will be in the $4 range. That's going to be below cost of production for many producers. So are we at a peak? Yes. Where we go from here, I think, will be highly dictated by corn and soybean prices over the next 6 months. If you look at corn prices that languish in the $4 range or something for the next 6 months, I would make the argument that you probably are looking for a little bit of a downtrend in farmland values. Talked to a large broker west of here a couple of weeks ago. He said they're already off Iowa, the state of Iowa, off 5 to 10%. I think some of our sales are showing a little bit of weakness for the average to below average quality tracts. If you watched our auction yesterday, it sold like gangbusters, but it was a high quality tract of land in a pretty tightly held, high quality area. So premium farms are bringing a premium still, but those that aren't premium, and even if they have good soils, but they have poor drainage or poor access, those are struggling a little bit more. So I think it's a kind of a healthy marketplace today, even though you're at the all-time high. And I think it's steady as we go through the fall right now, but there could be pockets of weakness due to the lower commodity prices and therefore farm incomes.
Yeah, we're going to talk about all the things that drive this value. I want to go to one of the things that you just answered, that really good stuff is still fetching a really good number. Really good, the best dirt that God made is still fetching a really good number. The stuff that's got some curve, some erodible, some lack of fertility, some of those issues. In past downturns, and you've seen several with your career, has that been sort of the canary in the coal mine? Has that been when things are going up? It seems to me crappy ground gets a bigger sort of exponential bump up. Like, wow, that bad ground sold really well, and it seems to catch like a wave up. But then it starts to go down. Almost, is it an indicator when what you just said, the great stuff only comes around once in a while? It's going to have lots of attention and lots of love. The stuff that's not so good, is it telling us something of where we might be going 6 to 12 to 18 months from now?
I think it is. And many of the people on this call, and I'm sure a lot of people have seen the Purdue Land Survey done in June. And one of the things they do is they ask the question about the values of three qualities of land: best quality, average quality, and below average. And if you look at the chart from 22 to 23, below average actually was flat to down a little. Average quality and premium quality both went up year over year. But that below average, to your point, Damian, didn't. And I think that is a leading indicator, because what does that tell you a buyer is doing? A buyer, when corn prices are $6, and we're looking at a profitable year, a buyer may say, yeah, I'll take that below average tract because it happens to be in the area where I am and it's the only thing for sale. So I'm going to bid it up, even though it's a little unreasonable. At the same time, when you get into high interest rates, so maybe I have to borrow some money to buy that piece of land and farm incomes are down, well, that'll come back around another time. So I'll just stay off of it for now. And our Bingham sale that we had last week was a little bit indicative of that. It was interesting. I'm standing at the back of the room toward the end of the auction each day, and we had some prices up there as high as $17,000 an acre. We also had prices on the board at $6,500 an acre, Damian. And so what creates that kind of difference? They're all in the same 15-mile geographic area. It was all about quality. And the principle of substitution, that economic principle of substitution, where, or opportunity cost, either one, principle of opportunity, was buyers basically saying, there's enough other good stuff or at least average stuff. I'm going to bid on that, and I'm not on that below average. So I think that is kind of a leading indicator. And it really then, how long do we see interest rates remain high and or farm incomes go down? That could then bleed more into the average and above average categories.
By the way, I'm going to ask a whole bunch of questions, but so are you. If you have questions, type them in the chat feature. Emma will get them to us, to Howard, to address. So we want to make this as interactive and informative as possible. The Halderman, this is not the first webinar that I've been involved in. It's the first one I've been involved in hosting, but I've seen them before. And so we're here for you. So make sure you type your questions. If you have them, we'll take them throughout. Nothing worse than getting to a question that should have been answered in the first 8 minutes at the very last 8 minutes, because it's like, wait a minute, we don't remember that topic. You talked about those big, huge tracts. I had a farmland investor, excuse me, on one of my podcast episodes, and his assertion was it takes really good land values to bring out bigger quality chunks. If things are slow, if there's a softness in ag real estate, the estate holders aren't going to roll out that mile square, 640 acre chunk of black flat dirt, because why would you? But man, you get some real excitement in the market, 3 years, 4 years of in an upcycle. All of a sudden, somebody, a financial advisor says, you know what, kids, maybe you should sell that chunk of ground. And we've seen that. You've seen that. You obviously have huge tracts that you're selling right now. Does that tell us that the smart money, if you ever think about what financial people say, what's the smart money doing? Well, it looks like some of the estates and some of the investors, to your point, are deciding it's time to go ahead and cash out. Does that tell us again, it's the time?
I think it does, Damian. Three instances. So the Bingham sales that we did last week, they were at a point in time in their life where, well, do we sell it or not? And I met with financial advisors and attorneys for their family. And in those discussions, it was, yes, we're at the all-time high. And I could see a steady to maybe a declining market for the next year or two. So if you're going to sell in the next couple of years, maybe now is the right time to do it. And that ultimately was their conclusion. We had a large, and Emma's telling me I got a question, so I will get to that in a second.
Get to it, yeah.
We had a large institutional investor out of the Western European Union. They had a parcel, and we do for them a hold sell analysis, Damian. So we say, if you hold it, here's the return you're going to get. If you sell it, here's the internal rate of return achieved. And they made the determination to sell one of their tracts in Western Indiana just last month. Because it was at such a high value, and this was a premium, arguably one of the better tracks in the state of Indiana with the pattern tile that we put into it. But it was a premium that was going to generate a double-digit internal rate of return for them, and they decided to clip the coupon. So those investors have a different mentality than the farmer owner. A farmer owner is owning it for multiple generations, and they want to grow their farm operation over time. They're very likely not a seller of real estate. But the institutional investor or the investor in general can take a little more of an attitude, well, is this the right time in the market to capitalize on that? So that I think is certainly a factor and another leading indicator to where the market might go.
Yeah. Thing is, by the way, that question references something that's already on our hot list to get to. It talks about a correction. So let's get through some of the other drivers of the land values, and then we'll get to that. So we'll get to your question, but since it's already something that we have built into what we're going to talk about, let's go ahead and roll on. The drivers of why we are where we are. You referenced interest rates, and this is significant in any of our working lives. Certainly there are people on this call, Howard, that remember 18% money in the early 80s. But that's not even been a factor. Most anybody that's, 35-year-old person out here is like, what are they talking about? 30. But we saw the cost of money, and one probably got to where they forgot that money is a tool. Money is an input. Money is a crop input. I mean, it didn't seem like it when it was at 2 or 3%. Now we've 2.5 times the cost of money in essentially 2 years. I don't think, this is me, but you're the expert, I don't think we've seen the impact of that. You spoke about the Federal Reserve. It threw this bucket of water on the fire, but the fire's still there. It doesn't seem like we've seen where the interest rates are going to actually have the impact. Am I right that we haven't yet seen it? Because you can't 2.5 times the cost of an input, which is what interest in money is, and not see an effect. I don't think we're seeing the effect yet.
There was a study by Iowa State University, 18 months ago, 2 years ago, when interest rates were really starting to talk about going up. And they argued that you would not see the impact in agriculture of higher interest rates until this fall, until the fall of 23, even though they started to go up 18 months ago. And I think there's a couple of factors in that. One, in the state of Iowa, 84% of the farms have zero debt. Zero.
Now, is that against real estate? Is that farming operations, Howard, or is that's on the real estate side?
On the real estate, mortgages, mortgage debt. But the other factor is the mortgage debt that does exist out there, probably those people refinanced at these low interest rates and fixed them in for a long period of time.
Yep.
So when you think about your biggest debt, mortgage debt, and it's fixed at a low interest rate because you probably incurred it more than 2 years ago, that doesn't have a material impact on your operation because you're still paying that low interest rate. But now new purchases or farm equipment or your operating line, those are at much higher rates for 23 and going into 24. So that starts to have a big impact on farmland. And I think that's where it was delayed. It isn't as immediate as the housing market where somebody's selling their house and they're getting and buying a new one and they can't transfer that mortgage. So they got to assume that higher interest rate right away. Yeah. Farmland isn't like that.
Yeah. So, and we got another couple of questions. We will get to a couple of these, but maybe another correction one because that's coming. Interest rates, then, we haven't seen the results yet. What does the smart money, again, we always talk about the smart money. What's the smart money think? When will we see the interest rates either cause a slowdown or even a departure? A farmland investor that was using some leveraged money at 3% looked pretty darn smart there a few years ago. A farmland investor that's not using cash, maybe using 30-40% cash, now using 8.5% type money. It seems to me that it has to start having an impact even in this fall's sales. The interest rates maybe didn't matter 6 to 12 months ago. I think they're really going to matter moving forward in the next immediately. Am I reading this right?
You are. It was interesting. We've been in the asset management business for farmland for 15 years, about 20 years. And for most of that time period, and these are for institutional investors, most of that time frame, it was about, well, what kind of return can farmland generate? And for the last 5 or 6 years, up until 2 years ago, farmland actually generated a higher rate of return than what they could do any other fixed income investment, CDs, money markets, those kind of things. And so as a result, farmland was a positive. And they said, yeah, I want to have that in my portfolio because it provides a higher rate of return. That's totally changed. Now you can go and get a CD at 5% and farmland cap rates 2.5%. So the investor, the institutional investor looking at their fixed income opportunities, bonds, treasuries, CDs, can get a higher rate of return on all those other instruments today than farmland. But they have not exited the farmland market. Why? Because they also wanted to have it as an inflation hedge. So we still have institutional buyers of farmland, and they're participating in our auctions, and they're actually buying it at some of our sales. And the reason is they want to have it as an inflation hedge because, oh, by the way, what did the last 2 years prove? Yes, farmland is a 1-to-1 correlation to inflation.
Okay, so then, let me just go right there because we keep hearing from, say, and we're not going to get political, but let's face it, politicians want to get reelected. We hear information, which I'm not sure is anywhere close to accurate, that we've got inflation just about under control. Tell that to the gas pump. Tell that to the grocery store, because you and I all feel that, right? Might the inflationary pressure that some of us think is probably going to persist for another 1 to 2 years just absolutely offset these interest rates to where then investor money still comes into farm ground as that hedge against inflation? Because I don't think smart money in any way, shape, or form believes that inflation is done.
I think it will. I think investor money is still there. But the key with investor money, they tend to have a higher hurdle and return expectation. So, for example, one of the clients we work with, they're interested in buying farmland at a 3 or 3.5% cap rate. Okay, that's not CD rates. They're willing to take a lower rate of return because they know they'll get appreciation over time, and it's an inflation hedge. But they still, at 3 or 3.5, are probably 100 basis points higher than the market today. So what that means is that if the farm market, the neighbor down the road, says, yeah, I won't pay that price. Maybe the investor will, but the investor is going to pay at a 3 or 3.5% cap rate, which is a lower price per acre than where we are today.
So real quickly, and we've got two of these questions we should get to, but let's go on that cap rate thing since you brought it up. Then we'll go to two of these questions from Steve and from Shashi. The cap rate, and you and I both watched the Purdue School of Agriculture, our alma mater, agricultural economics data, and they talked about we've always accepted a lower rate of return on farmland, whether we're farmers or investors, because there's the inflation hedge, the fact that you can see it and touch it, and it's always had that perceived safety element, if you will. But at these prices, we're expected to receive a tremendous amount of a lower one, like your investor person there, and so. Is that going to fool the math up? Is that going to change it? Because you have a slide about that you shared that, like you said, the investor would take a 3.5% or so return rather than a 5% CD because of all the reasons they like farm ground. But there's no 3.5% returns even using cash.
Correct. And so I think that's where the rubber meets the road on farm incomes. And if farm incomes, and that's where I said, if we get 6 months of lower corn and soybean prices, where we're below cost of production, then the farmer probably looks at this and says, yeah, I don't want to pay quite that premium. And maybe that means they want, you see the cap rate move back up towards 3.5%. Well, the only way it moves back up, two ways. Either
higher cash rents or lower land prices.
Or lower land prices.
That's it.
And that's exactly what we saw. And this, I think, gets to one of the questions. What we saw in 2014 and 2015 was a 5 to 10 to 15%, maybe a 20% decline in land values, which was a healthy correction because we were looking at much lower farm incomes as we went into 15 and 16 and 17. And so the farmland market came off that and reverted back to that 3.5% cap rate, and got back to a number that investors are happy with, and the farmer was still willing to pay. So that is one indication, and that's why I said earlier, if we get that kind of long-term price indication for corn and soybeans, you can make an argument for a little bit of a downtrend in farmland values.
Howard, because I'm going to release this as a Business of Agriculture podcast, I always assume that I've got a listener out there that sells cans for the cranberry processing business that right now is saying, oh my gosh, this is over my head. Cap rates very simply just mean the return on your investment. And that's really what we're talking about. So the only way that improves is the investment price goes down or the rent that you're allowed to charge goes up. And it's a real simple thing. So for the person that's out here that's like, oh gosh, you guys got into Ag Econ 303, 301, whatever the number is too quickly. So let's go ahead and address that. First question from M. Berger was, do you see a possible correction similar to what we saw in 2015 in that 20% range? And you just said 5 to 10%. We saw 20% in that from 2014 to 2018, Howard. 20% was on stuff that maybe sold a little too high, or it was I think the worst we saw in that 5-year correction was about 20%. Did we see anything worse than 20%?
No, we did not. And there were a lot of areas that were 5 to 10 because they're tightly held, high quality. Maybe they have a higher basis for corn and soybeans. I'm thinking generally the Lafayette, Indiana region. Always tightly, high demand for corn in that marketplace for a variety of reasons, and great quality land. That's not going to probably experience the 20% decline, whereas some other areas struggle more.
Yeah. So 20%, if you're going right to, do you see a correction? You're saying, yeah, it could be 20, but it's not unreasonable. A 5 or 10% is probably frankly healthy. And you know what? It seems to me, Howard, and you answer me this, you probably don't ever have a buyer that buys now that next year things are down 8.5% that calls you up saying, man, you screwed me. Things are down 8%. 8%, I think a lot of buyers look at it and say, oh, yeah, I may be overpaid a little bit, but that's the kind of correction we can live with. Everybody can live with about a 10% correction. 20 starts to hurt a little bit. Is that accurate?
Well, we've got over 100 people on this call, and I want everybody to hear this. If you are buying farmland, it is not an asset you day trade. So if you buy it today, do not try to sell it in a year, whether it's at a profit or a loss. Because farmland is a long-term investment. And I've said this to institutional investors and to individuals alike. If you want to get into the farmland space, what you really need to do is plan to hold it 10 years or more. Because then at 10 years or more, you're going to get that long-term historical appreciation of 4 to 5%. And you're going to add in a 2.5 to 3% cash return. And you're going to have this nice 7 to 8%, very safe, zero vacancy rate type of asset. But if you try to day trade it and I want to make a buck and flip it next year, that's more risky than what you really imagine. One of the things that we've experienced is that a lot of folks remember what you paid for it a year ago. There are public records as to what you paid for it, sales disclosure forms that are required to be filed. And sometimes the market just says, you know what, that profit isn't going to be there. So my caution is if you get into farmland, do it long term.
By the way, there might be somebody listening here that says, okay, I bought this for 10 grand an acre and it's along an interstate. Amazon wants to give me 50 grand an acre. Can you please put an asterisk on that, Halderman? If Amazon wants to give you 5 times what you just paid for it, can they day trade that?
They can day trade that all day long, Damian.
And you can help them roll the money, and you can help them roll the money into their next investment?
Ideally it's 18 months, so you get the lower capital gains tax treatment that they've held it. But even if it's shorter than that, yes, we can help them do a 1031 exchange and prevent paying the capital gains tax.
Question from Steve. With the high-priced farmland, isn't the buyer expecting a negative rate of return, at least in their lifetime, in the case of a farmer buyer? Well, obviously, Steve, I'm not the expert here that Mr. Halderman is. It depends on one's lifetime, I guess. I mean, if you live another 40 years, you're going to have a negative rate of return maybe in the next few based on, but even then, we're not negative right now. We're just low on the rate of return. Am I right?
Correct. Yeah. What could happen if we get that long run of lower corn and soybean prices? We might see a decline in asset values of 5 to 10%. If, assuming you don't borrow any money, if you go out and buy 100 acres today and you pay $15,000 an acre premium price, that's $1.5 million that you got invested. That may decline in value, but I will assure you it will make money. And you will generate that 2.5 to 3% net cash return on that asset every year. And it'll pay for itself in that regard. Now, if you lever it up more than 30%, it might get difficult to cash flow it because of the debt that you have to repay. But certainly, if it was an all-cash deal, you will make a cash return on that that's positive, but you might have that negative appreciation. So that's where long-term, you start to make that 4 to 5% long-term average appreciation. And that's why over a 30 or 40-year time period, farmland is a long-term 7 to 8% kind of return.
And I'm going to ask a question that's not on the list over there. You've quoted those numbers before, and we can talk about like a 20-year window where if you any time in that 20-year window you've made out on it, et cetera. So there's a lot of that. The interest rates have always moved. Demand has always kind of come and gone. This is not the first era of outside investors coming in. I mean, I used to make the joke on one of our conversations, Howard, when I go to a land auction, I'm going to put on my name badge, investor from Chicago, because any auction you go to, if they don't know who you are, I heard some investor from Chicago bought that land. So that's always been a factor. But going to our next question, something that's not always been a factor that's pretty new. Alternative land uses. And this question from Shashi addresses things like solar. That's a new thing. Investor from Chicago is not new. Interest rate fluctuation is not new. Commodity price volatility is not new. Solar and alternative land uses are new. Help me out on understanding that. What's that do to our market?
They are new. What I can tell you with assuredness is that wind is not as new. Wind turbines, and you see a lot of those in a variety of locations around the United States, around the world for that matter. A wind turbine on a farm, on an 80-acre farm, will tend to add, based upon our comparable sales, $600 to $1,000 an acre in value, $30,000, $40,000 bucks, and maybe that's $500. But that's going to add value to that farm. And basically, it's just capitalizing the income stream coming from that wind turbine. Now, wind is different. Wind obviously has a visual change. It has a little bit of noise, but it only takes, an acre of ground out of production. Solar, on the other hand, takes a lot of acres out of production. You're going to no-till that ground effectively because it's all going to be in grass or a bee pollinator mix. You're going to lay it idle. It's not going to have any erosion. It's actually going to build up organic matter. And it'll have these solar panels. But these solar companies are offering anywhere from today $1,000 an acre, maybe $1,500 an acre annual rent, which is 3-4 times higher than farmland rent. But you're locking that away for 30 or 40 years based on their contract. And who knows where farmland commodity prices go in the future. So it's an option for somebody, a landowner, to consider. These solar and wind projects tend to go where you can access the grid and access it readily, easily. So you have to have the grid, have to have a transmission line with capacity. That's a key. And you want to be at a point of interconnect or close to a point of interconnect where you can put the power into the grid. You're generating DC power. You're going to convert it to AC and then put it on the transmission lines. So location becomes pretty critical to these developers. That being said, there are very few, if any, commercial solar farms that have sold large scale. There have certainly been some smaller ones, 5-10 acres. But these are just in development. So I don't have a lot of data at this point, Damian. What I can cite you is there was an appraisal shop out of Chicago that studied sales of properties around a solar installation. And these are smaller ones, but they were northern Indiana, South Bend area, Marion County, down in Indianapolis, and some other locations. And the indication was that they had no material impact. I think, in fact, it was a 2% positive on land around it, but that wasn't the solar development itself. One can argue, based on wind, that you would capitalize that additional income into a higher land value. But until they sell, I really don't know how that's going to turn out.
And this is not completely, Shashi's got the questions. How are these factors trending or impacting this? We said that solar's new. I heard my first discussion on solar at the Illinois Society of Real Estate Appraisers and Farm Managers. And it was like 5 years ago. And of course, my first question was, why are we putting solar in Indiana and Illinois where we have really good farm ground, we get adequate precipitation, and also there's no sun for 6 months? But that's aside from that because we're not going to get political here. The real question, though, is wind has a track record. The first windmills went up like in Benton County, Indiana, or over near Bloomington, Illinois. Those went up, like, Howard, almost 2 decades ago. And they have a track record, right?
Yes.
And so they have a track record of actually paying, whereas solar, we're hearing about leases being tossed or options being put out there. We'll give you, get some money if you give us an option sometime in the next 2.5 years. We want to maybe put in a solar farm. It's kind of nascent, to say the least. Do you trust it? And I know you're probably not in advice of this thing, but is it going to be here, given the reasons I already talked about? Lack of real sun, political changes. If you had a customer come to you, client came to you, so I'm really looking hard at putting this solar in, what's your reaction?
We actually have worked with some solar developers. And when you're dealing with one that is the largest developer of renewables in the United States, and they've done a bunch of solar installations. Now, I had one that I did a project down in Texas on a property in East Texas where they don't get as much sun. That's a 10,000 acre project. It's being done. It's getting done. So I believe most will happen. I think that's an interesting question. Certainly the big project up in Pulaski County, Indiana, is being constructed now. And that's upwards of 3, 4, 5, 10,000 acres, depending on what they get done. But you're right. A lot of these so far are options. So you got to look into who's behind the option, who's the developer, have they done it before, what kind of balance sheet do they have? And many of the ones that we've talked to have significant balance sheets. But then the question becomes, can they get that commercial field approved and permitted. And I think that's going to be a bigger challenge. And that's really dealing with county by county. And will the residents in that county, will the plan commission, will the commissioners actually be supportive of a solar installation?
Okay.
And I think that'll be the bigger challenge on some of these solar developments.
You mean local politics? We've seen
Yes.
Huntington County has an ordinance again where I live, my farm, next county over from you. There's not wind is not allowed. Same with your county, I believe. By the way, we're going to skip a couple questions and go to this other one from Tom Vogel because he's kind of talking about this very thing. Also, he gives accolades. He says, Damian, Howard, you gentlemen are brilliant and make a lot of sense. Tom, I'm going to take you around to family reunions, and I just want you to say, hi, I'm Tom Vogel. Damian, it's brilliant. It makes a lot of sense. Anyway, he says, think you're focusing too much on pure agricultural prices. And he asked this before we got into the solar stuff, and not enough on other uses of land today. Everyone far and above farmers and investors wants land today. Solar, cell towers, hunters, playgrounds for the wealthy, and wind turbines. The returns are coming from other sources besides farming. Tom, I hope that, because you asked this question 13 minutes ago before we got into it, we've kind of addressed the solar thing and the wind thing. And I'm going to go ahead and then sort of pivot this back to Howard. There are areas that are absolutely dead set opposed against wind. I don't know who began those initiatives, but we saw signs in my home county, no wind, no wind farms, whatever. I mean, it was in period. It's not happening. I have a friend that's an attorney. One of his big clients was finding counties that wanted to put in ordinances against wind. So, okay, we've already addressed that one. Solar, it's nascent. It's preliminary. There's companies tossing options out there where they give you a little bit of money and want to tie up your land for a potential solar lease 2.5 years from now. I think we've kind of covered the green energy space for demand on land, Howard, but let's talk on some of the others. He talks about hunters and playgrounds. You have some very good data on that. We've talked about solar. We've talked about wind. Demand for agricultural land or rural property from the playground, rural hunting, fishing. I want my kids to be able to play in the woods. Speak to those values.
Those values are probably close to the all-time high as well. In fact, I'll reference a sale we did just a month ago up in Steuben County, Indiana, northeast corner of the state. Steuben County, when I started in the 1980s, had the highest number of acres of conservation reserve program land in the state. Essentially, Damian, that means it was a lot of highly erodible land. It's rolly, it's hilly.
It's got hills, it's got lakes, it's got curves, if God wanted you to be a farmer, he'd have put you somewhere besides Steuben County, Indiana.
That's probably fair. I don't want to offend any Steuben County farmers, but they probably would acknowledge it isn't quite as good as Tipton and Benton. So this 200 acres brought $10,000 an acre, and it's all woods or recreational land. $10,000 an acre. We had tremendous volume of bidders on that. And so you're right. I think COVID had a little bit of an impact demographically in this nation, where folks all of a sudden said, I don't have to live in a highly populated, densely populated area. I can live wherever I want, and I can work remotely, or at least work remotely some part of the time. And so if I have my druthers, I'm going to live on some beautiful piece of property someplace. Yep. And so those other uses for recreation, and that includes hunting, four-wheeling, fishing, that demand really tends to track the general economy. So if unemployment's low and jobs are out there, folks have that discretionary money that they may want to buy and own that kind of piece of heaven that they might want to live on or at least go to on the weekends. And so those values are at all-time high levels as well. And so, yeah, you're right. Those other uses are certainly tracking higher.
I would like to share this, and I want your input. And I like Tom Vogel's point here, not just that you and I are brilliant, but the one about the alternative uses of the land. If we see a downturn in commodity, and I'm not the expert here, but if we see a downturn in commodity prices, which we already are experiencing, and we see commodity prices to where we're below cost of production, we may see And also, based on what's happening with the government right now, it looks like there's a big push for more funding of green. We're at 23 million acres of CRP, conservation reserve type property. And as Howard pointed out, Steuben County had the most of it in his territory 30 years ago. There may be a push to put more marginal ground into CRP. And if that happens, that then props up demand for some of the crummier ground that we just were talking about that loses value. So can you speak to that? Because the buyer of those acres will say, I'm not a farmer. I want to take this 65-acre oblong-shaped thing. It's got some woods. It's got a creek. It's got some below-average farm ground. I'm going to put it in CRP, buy it, stick me a little cabin in there, and me and the kids are going to go there and hunt mushrooms and get away from it all. Is that where you see things going in a depth? If we have a slight downturn in commodity prices, slight downturn in land values, that maybe the value for those crummier acres, less valuable agricultural acres goes?
Yeah, I think that clearly the farm operator is going to look at that piece of land and say, yeah, in today's marketplace, below, at break even and high interest rates, I don't need to own that. So the price of that then defaults to, well, who else would buy it? And they'll either buy it as a recreational piece and enter it in the CRP, maybe the WRP, or lease some part of it to a local neighboring farmer to generate some income. But typically that would be a little bit less than farmland values. What we've seen, though, the last 4 or 5 years is that's actually gotten to be where it's more equal with what that below average cropland is worth. And it will depend highly on the quality of the piece of land, the hunting habitat, water or not, timber values, what's the hardwood timber like in it when you talk about Eastern Corn Belt. There was a question by Catherine at some point, supply and demand in terms of valuing farmland. I think one of the things you have to keep in mind when you think about supply and demand, in theory, you'd say, well, these developments like what the IEDC is doing down in Boone County, that's taking a bunch of land out of production. At some point, we need more land, cropland, or it'll become more valuable. Keep in mind, Brazil has thousands of hectares they can expand. There are other places around the world that can expand their agricultural production area. United States doesn't have much, but there are some other geographies, sub-Saharan Africa, Brazil, and some others that could expand to grow more food if needed in the future. Clearly, it comes down to capital and capital availability and political risk and a whole host of other factors. So I'm not necessarily recommending you go and buy there. It's just, I think you have to kind of keep that in the back of your mind when you get excited and say, yeah, this declining mass that we have of land in the United States is going to generate higher prices. It's not actually a one-to-one correlation because of
by the way, I like that you said that, because we've all been around farms and ag in our whole careers, and we hear the people say they ain't making any more of it. And then you do some research into what's happening in Brazil, and Brazilians say we might be able to enter 90 million more acres into agricultural production in the next decade. That would equate to the number of acres that we grow corn on in the United States. So there is that reality. So, will carbon capture, this is a question from Edward, will carbon capture be coming in Indiana? How will that impact farmland prices? It already is, and I want to hear Howard's expertise. I've been trying to figure this out for 3 years now. A company like Indigo that came into this space, and I was trying to figure out who Indigo was and why they were sending me emails 5 years ago. They were sort of the beginner of this carbon capture, et cetera, was one of their first things. Indigo is worth 95% less today that they were 5 years ago. The company Indigo was in this space. There are a number of other companies. True Terra, which is a subsidiary of Land O'Lakes, sponsors my podcast. They are in this space, but it's still, there's not a lot of acres signed up. It's kind of the Wild West. There's not a set amount of dollars you get per acre or even per ton of carbon sequestered. The measuring and the fundamentals of the marketplace seem a little underdeveloped, and I'll let you take it from there, Howard, on where you see this going.
Well, I think the reality is a lot of those carbon programs were asking for a long-term commitment. It had to be new land, so your current no-tillers didn't qualify. So new new producers looking at and say, I got to reduce tillage, and we use cover crops. That's all new practices that I really don't know how they're going to work. They're going to cost me something because I got to spend the money to buy the seed for cover crops and additional field work. So, but I'm getting $30 an acre. That's all. Mm-hmm. I think a lot of it was the economics just didn't make sense. And then, oh, by the way, I've got to commit to this for 10 years. Pass. I'm not going to sign up for that. And I think that was kind of the reality of it. So carbon capture, I might argue that I think there will be more sustainability practices. I think the opportunity might not necessarily be carbon sequestration as much as it is, I know my corn, my soybeans, my beef, my swine were grown sustainably. And will the consumer, will Coca-Cola, McDonald's, you go down the list of consumers, as well as the individual consumer say, I'm happy paying more for a sustainably grown whatever. Yeah. And I think that we've seen that locally grown initiative, I think sustainability might have a little more traction than just carbon credit. Oh, by the way, if you're doing things sustainably, you're probably sequestering carbon too. So you accomplish both. The other thing on the carbon front, Damian, is that there are these groups now talking about siphoning CO2 off of large CO2 producers, ethanol plants, example, or large manufacturing facility, large power plant, take that CO2 out and pump it underground. I don't know the science of that, so don't ask me about that. But I hear that the geology in the state of Indiana and Ohio and Illinois happens to be pretty good for that. Yeah. And so that could be an income opportunity for a landowner with no disturbance whatsoever to their use of the land at the surface.
I've got a couple of observations, and again, this is Howard's expertise more than mine because he deals with land and making money off of land every day. The thing meaning the carbon thing seems a little underdeveloped, and it's difficult to understand. You got two guys here with agricultural economics degrees from one of the top 10 ag universities in the country, and we don't still understand the marketplace. And if you threw any other marketplace out here, we could probably figure it out because it's not a true marketplace, I guess, is the answer on the carbon stuff. There's another aspect. It seems like the attention span for that was really neat among people that wanted to, consumer companies, call it Procter & Gamble or anything else. And already there seems to be a shift in attention away from carbon now to nitrogen and nitrates and reduction of nitrogen fertilizer over application and those kinds of things. So it's as though we didn't even really have the one thing concrete, and we've already moved the goalpost again. So it's a little bit screwy. It's not a true marketplace, and it's a little bit screwy, I guess, would be my thought on the carbon thing. But if you and Howard would just be like the wind. If he has a chunk of ground that says, and there's a contract for the next 20 years that Procter & Gamble is going to use this as its poster child for the way they farm, they're putting 1.2 tons of carbon into the ground each year, and Procter & Gamble wants to be able to use that to sell Crest toothpaste. Howard's going to say, you know what, this chunk of ground gets an extra $47 a year for a carbon program through Procter & Gamble. It becomes an income stream that he references and uses in the literature to sell that property, right? It's just that we don't have those yet.
Yep, exactly.
They're not really there.
No.
Yeah. We got a question then from Edward Britton. He has a pretty lengthy discussion here, but we'll get right to this question. U.S. stocks to use ratio for corn and soybeans increasing rapidly with another 2023 crop likely to increase these ratios. So he's talking about farmland investors' repayment capacity for mortgage debt from the assets income is not available under these high farmland prices. So he's talking about it being a reality check. I think what he's alluding to is we are going to move into a lower commodity price horizon because of our stocks to use ratio. We're going to be well supplied probably on our commodities, and that's probably going to make the repayment capacity diminished, and that will put the reality check on farmland prices. What do you see?
Yes, if that's what your assumption is, you are absolutely correct. One thing I would point out, most farmland investors are not using a lot of debt. Institutional farmland investors are using no debt because why would you borrow money at 7% when you would generate a return of 3%? That doesn't enhance your internal rate of return. So most of the time, if they use any debt financing, it's for improvements, irrigation or drainage or grain storage that returns a 10+% return. So that's one point I would make. But Edward's right. If they are borrowing money, that repayment capacity is dramatically changed, and that reality check hits home. Stocks to use ratio isn't just it. There was a question early on about the value of the dollar. And one of the things, because the United States has had a pretty good economy through this, and China's is kind of wavering, and maybe some other places, the dollar has gone up in value, which means our exports are more costly. And at a time where Brazil is beating us in terms of soybean and corn exports on an annual basis, theirs are just cheaper because of the value of our dollar. So there are headwinds out there, certainly for commodity prices. And right now we're at a low in corn prices. It depends on who you read. Maybe we'll start to see those move up. I think a lot will hinge, Damian, over the next month. And what are the actual yield results? Because this year's crop production was more variable than I've ever seen. And there will be a ton of variability in field to field, township to township. And, the story on the 2023 crop, I think, is yet to be told until we actually get a little further along in harvest.
Isn't it interesting? You just said that, okay, the Pro Farmer Tour, speaking of U.S. production, this is Pro Farmer Tour says we're going to be at one number. USDA says we're going to be at another number. And, to the casual observer, they're probably thinking, okay, we're 3 bushels apart on 2 bushels apart on a soybean estimate and 4 bushels apart on a corn estimate. Whoop-de-doo. Well, you put that over 90 million acres, it's a hell of a lot of bushels, which does then, because remember the price, and this is something that's hard for some folks to even me to grasp. Your price movements don't happen by the first 3 billion bushels of soybeans. The price fluctuation happens between the 3.4 billion and that 4 billion number, because that's where the tightness or the excess occurs, right? So right. That's where you said, Howard, maybe our numbers are not, the combines haven't run. We think we have an estimate. You put in a 4% swing on supply, it has a big variation then on the price movement, yeah?
It does. Huge dollar type of swing. So that's where, and it was interesting, I was reading a report this morning, and the writer said, well, the early results of harvest in Ohio and Indiana are extremely positive on soybeans. Yeah, those were planted in April. And then we went a month with no planting, and 2/3 of the crop was planted in late May. When did those soybeans need their moisture? Well, that would be late August and early September when we didn't get it. Yep. So that's where I don't know yet until the combines, and that's where I think the story of this year's crop is yet.
We've got a question over here about those currency things that you just spoke on. International currency relationships determine to a great degree the ability to export grains. Corn and beans are now suffering because Brazil currency in the relationship to the U.S. dollar is one of the causes that China is buying from Brazil versus the U.S. That's true. You addressed that. Do you have anything more you want to do on where land? Because remember, the question of the whole overriding theme of today's webinar was our ag farmland prices at a peak. International currency relationships. Is there anything more on that you didn't get to?
No, I think the international currency relationships are going to are heavily impacting commodity trade. And when our dollar is high versus any other currency, that hurts our trade, hurts our exports, hurts our, at the end of the day, price. I will like to point out, Dan Dawes did bring up Purdue is a top 5 ag college.
Oh, thank you, Dan. Top 5. Okay.
We may not be as brilliant as we thought.
I don't know. Well, 8 we must be, because we went to a top 5. I've got a couple questions over Annie, Hawk, and then Catherine. Speaking of crop variability, so Catherine says, what factors contribute to this year's crop variability? I'll go, then you can go. Your fingers on this more than mine. You just spoke about variation in planting time. We had a variation in planting time, and then we had, I'd say, a little bit more variable weather than most people think. I was in Western Iowa in July. Western Iowa was 100 degrees, and it had been terribly dry, then caught some rain, then got terribly hot and dry again. That's not typical for Iowa. Maybe when you get out in the mid plains, So there's going to be that. So I think there's going to be some yield drag there. You also just talked about like where you and I live. What makes those finishes out those later crops is that August and September precipitation. We got our first rain at my farm. My wife tells me yesterday it drizzled a 0.2 of an inch or something. And that's the first precipitation measurable we've had in 4.5 weeks. So there's where I think we're going to see some yield drag is variable weather in places that don't typically have some of the extremes, and also planting dates. Is there any other thing that you think contributes to the crop output?
You nailed it. The variability of planting times and the timing of that. Then here in Indiana, we planted some in early April, went a month with nothing happening. Then we plant some more, and it turns into a flash drought. Did anybody remember we had a flash drought the first 3 weeks of June or late May, early June, and 90-degree temperatures? Yep. Now, generally at that point, it doesn't hurt the crop a lot, but it might hurt it some. Then we got plenty of rain through July, which makes your corn crop, but very little in August and September.
Which finishes your soy. And that's just our part of the world. But also when you travel a good bit, as we both do, I mean, you're talking about there's some weather stress, I guess is the easy way to put it. And again, if those USDA estimates are off by just a few bushels, remember your spread on pricing, it happens in that last few bushels that create you either a big swing up or a little tightness on the bottom side. Catherine Frazier asked that question about variability in crops. Annie says impact of the war in Ukraine. Isn't that already baked in? Isn't that already pretty much, we've been dealing with it for a year and a half? No offense, or we're not lacking empathy for the situation, but hasn't the marketplace pretty well absorbed what's the Ukraine impact?
Yeah, and if it hadn't, the deal with Russia has been out of alignment for a month, or they lost that agreement back in July or August, and so there are some shipments occurring. But yes, I would agree that the war and the trade from Ukraine, that's all been factored into the market today. So what's been the impact? In theory, you would think that would create higher prices for us. It hasn't really. Most of the places Ukraine sends their grain, we don't. So it has a global impact on the supply of corn and soy, or corn and wheat, not so much soybeans. But that's all been part of the trade and already in the price.
By the way, and you talk about where's theirs go. Remember, it is still a global marketplace. So if they're not supplying somewhere, that still opens up a vacancy of supply, which is then we could, demand that we could supply. But it seems like it's been baked in for a while, unfortunately, with the thing now going into its second crop year in Ukraine. I got a couple of my buddies on here, by the way. Joe Van Meter, who is a farm owner in Ohio, is on here. But also we got Alec Bean. He's part of my Business of Ag Success Group. He's like down there by Champaign. I think if you're like one of those people by Champaign and you ever even complain once about anything relating to your farm ground, you know what?
I agree.
You should. It's like the world's most gifted athlete complaining that they had a bad day of practice. I'm like, no, shut up. I can barely touch the rim. Okay. At what point does the institutional money stop or slow down coming into farmland? Still, most sales seem to be to farmer, but institutional money is setting the floor. Alec Bean contends that it's institutional money that's setting the price floor on these farm sales. You have a very good chart about that. So far in 2023, the percentage of land that is being sold to farmer and the percentage being sold to investors. So can I speak to that, please, Howard?
Yeah, and again, if people want my slides, happy to send them to folks. But you're exactly right. And Alec is right. He could have done this presentation. The institutional money.
He's an Illinois guy. He's an Illinois guy.
Oh, no, he couldn't then. He's no longer qualified. Yeah, the institutional money sets the floor because they tend to take a little higher rate of return, require a little higher rate of return. So they'll bid up to a price, and then usually it's been the farmer buyer taking it on up from there. So when do they stop chasing farmland? I might argue they won't. One of the things that has happened is farmland has become an institutional class of investable space. Timberland did that way back in the 80s and 90s. Farmland started in the 90s, but really became viewed as an investable class, an investable asset here in the 2010s. And there are a lot of different folks out there investing in farmland. And a lot of money's been raised, honestly, to chase it from a sustainability theme and standpoint. You've got the inflation hedge. So even though the rate of return from a cash yield standpoint might be down, you've still got the long-term appreciation. You've got the sustainability theme. So if I own some farmland that's being farmed sustainably, that is a boost to my overall ESG component. And trust me, other parts of the world besides the United States, that's still a big initiative. And so I think the institutional money is here to stay, but does it slow down a little bit? I think they just become very passionate about their return. And if they can get their return, great. And if they can't, I think they would look at a little bit of a downturn as an opportunity to buy, honestly, Damian.
So by the way, on that, you even think like pension funds or endowments for like Harvard University would own vast tracts of timberland in Maine and then contract with a paper mill company, pulp, to harvest it. And then they can go to their Harvard donors or their pension fund people and say, we're diversifying your investment. And also it's good for the environment because we've got trees growing on, et cetera. Are you saying that same mentality is now coming to even corn and soybean and wheat property?
Yes. Yeah, they look at a diversity in their portfolio. And now keep in mind, most of these pension funds, they're looking at a 1 or a 2% allocation to farmland. So it's a very small percentage of their overall fund. Most of it's going to be in equities. But what they're doing is they're diversifying their portfolio with farmland because it's a positive inflation hedge and because it's a fixed income component that generates a positive cash yield year over year. So I think they remain in the space. The question will be when they start to buy a higher percentage of the land. Well, what that tells me is the farmland market's coming down to them. You follow me?
Yeah, they look at it. Okay, and speaking of coming down, we got a question from Edward, and then I want to know, in the interest of time, we've got a number of things we could do, or maybe even hit them on another time, because we've got interest rate comparisons, we've got debt to income comparisons, we've got WAPI, and I'm happy to table that if you want to get to these questions, because we've got really good activity on this, and that could be for another time that you cover in another one of these. But I'm just saying that over here on the list, there's a bunch of things that could be covered, and I'm not afraid to let you push them off to your next one.
Why don't we push them off to the next one? I can cover the WAPI charts pretty quickly because I think there is some interesting information there to glean out of it.
Well, that also points back to some of the other things. That points back squarely to our farmland values at a peak or not. That's more on topic. Edward Britton says, you started out stating farmland values are an all-time high for premium land. The smart institutional investor understands probability to now decline is highly likely. Yeah, or at least more likely. Institutional investors using cash or other equity and non-institutional investor or a 1031 exchange investor is thinking, he says, what are they thinking from your client? So that's a question. He's saying, what are they thinking? Meaning, do you have clients that come to you knowing that we have a probable decline in the next 12 months? I'm going to answer for you, and I want to hear your thought. I give money to my Morgan Stanley Smith Barney guy every year because I have to for my my IRA. And I might say, boy, things look a little high, but I still want to go somewhere with that investment. And so the idea of it being long-term is still there. It seems to me that you probably, Howard, have the same thing. You counsel your people. Is this something you're playing with tomorrow, or is this something for the next 10 years? I'm guessing that's your answer.
Yes, and great case in point. I was at a meeting in New York a number of years ago, and I was sitting down with two. One was an endowment for a university, and the other was a pension plan. And they said to me, well, Howard, do we want a 15% return? And I said, that's not farmland. And they said, well, what do you mean? And I said, well, if you want 7 or 8, that's farmland. That's a long-term. Well, we want 15 and we're looking at 5 years. And I said, well, this meeting might as well end because that is not farmland in my view. You need to hold it 10 years. You're going to get a 7 to 8%. And it's like widgets coming out of a factory. It's a very safe investment, but it's not going to generate usually very high double-digit returns. Now, can you get a 2021 where the farmland market went up 40%? Sure. But that's one every 40 years. So plan on the 6 to 7 to 8% and enjoy it.
And which that's the, like you said, that's historically when the people at my winter home in Arizona come over and have cocktails and tell me they want to buy Indiana farmland because they just read in the Wall Street Journal that someplace in Iowa sold for $26,000 an acre and it was bought 2 years ago for $11,000 an acre. I say, yeah, that's not going to happen. Sure, no. That's not going to happen.
In Missouri, just last week, farm sold for $34,000 an acre. So Missouri now has the record for high price for just farmland value, not for development. So,
all right, go hit Whoppy, and then my buddy Joe has a question for us, and we got something from Gary, and then we should probably look about wrapping this up.
Okay, so weighted average productivity index, Whoppy. All soils in Indiana are mapped and you can map your field, and it'll tell you what soil types exist, and every soil type in Indiana for cropland is weighted for its ability to produce corn. And so a Brookston might be 165 bushels to the acre, and a Glenwood might be 125 bushels to the acre. Basically, you map your field, you take the different soil types, and you average them, and you come up with a weighted average productivity index for that field. And these are actual sales results, Damian. So we sold a farm back in Q1 of 2023 for $141 per corn bushel of productivity index. Likewise, we sold one here just a week ago at $42 a bushel of productivity index. So every farm is unique. Every farm has a different characteristic about it. So you see a tremendous amount of volatility in these numbers. But what Pat does for me, Pat Karst, he basically takes every farm that's 80% cropland or more and doesn't have some anomaly to it, and we put it in our Whoppy chart. And this just shows you where 2023 has gone, which is kind of a depressing sight, right? The average for the year is around $80. Last year, we were at $90. So you might argue, well, gosh, Howard, that's a 10% decline. Maybe. What you see is we sold a farm last night at auction, online auction, over $100 per bushel of productivity index. Premium farm, premium area, premium price. The farms that have brought this average down were average to below average farms. Those are the two big sales we had. Some of the tracts were not super duper pieces. So therefore the decline. This bears watching over time. These are just our sales. Maybe it's not enough of a representative sample. This is the trend 2016 through 2023. We had that 10 or 15% decline back in 2014 and 15. Then we had a big sideways time period from 2016 through 2021, then the 40% increase. And one of the things I said at a seminar at the Top Farmer Workshop at Purdue back in January is expect more volatility. And if you look at the range from the high to the low on the far right-hand side of this chart, since Q4 of last year, we've seen more volatility than the rest of this chart. So that's more of the high and low of, I think, what the higher interest rates and lower farm incomes impact are going to have on the marketplace. I did ask Pat, I said, does quality matter? Whoppy is on the bottom here. So bushels per acre from 111 to 173 on the bottom. And if you basically look at this chart, you say, yes, better quality farms bring more dollars per bushel of productivity index.
What's interesting,
usually you say bigger pieces bring less than smaller because more people can afford a smaller piece. This goes from 24 acres on the far left to 615 on the far right. And as you might theorize, yes, bigger pieces do bring a little bit less per bushel of productivity index. So just a couple of interesting studies that we did.
Well, first off, I've been around for a while, and I still have never actually knew what weighted average productivity index was or meant. It makes complete sense because it's comparative based on its productivity. What's interesting is the amount of variation even within a similar Whoppy. I mean, because there's somebody really wants that, you can give an average of a Whoppy index, but you can't tell me that there's not a degree of variation, and that's based on location, who's at the sale, who's in love with that property, who doesn't care about that property. I mean, there's still a lot of variation even within the same Whoppy.
Well, we had this sale last year, two sales actually last year on November 29th, and I just happened to note them because they were the same day. And one was Cass County, Indiana, in an arguably a weaker part of Cass County, north and east of Logansport. I'm not being offensive to anybody in the 12-mile region, but this is where this farm was. And you can see the WAPI on there. It was 148 bushels to the acre. That is slightly better than average for the state. 140 is average. Delaware County that evening, 145 WAPI. And they bring 100% difference in price, Damian. Why?
So
it's location and reputation. So the Delaware County farm was known as the best farm in Delaware County because of the management that it had, the way the crops always looked, drainage, etc. So location and reputation, do they add value? Why do you want to maintain your property, mow your roadsides, put in tile drainage, do proper fertility, don't have erosion on your farm, do sustainable practices? Why? Because it translates to value. And this was just kind of interesting.
It looks to me like it translates to double value.
Double. Well, location factors into that. So you got to, you can do this in a bad location and you still might not get double, but you will get more. So
that's a great study. Okay, here's for Alec. Our friend Alec Bean asked about who the farmland investors. So 35% of sales in 2023, and these are yours. These are specifically the ones that your company has administered. So we don't have data from the People's Company and the Farmers National and all that, but using your Halderman Real Estate, and that's from January 1st until now, or is it the last 12 months?
No, it would be until now. So the first 9 months of the year.
Okay, first 9 months of the year, you're sitting at 65% were farmer purchasers, 35% were investor.
Exactly.
Can we go back?
I get this question all the time. Well, how many acres are the Chinese buying? First of all, the state of Indiana no longer allows foreign ownership of farmland. So if you're foreign to the United States, you can't buy here. That's law. There are ways around it, but that's not for now. But my point would be, I've never sold to anybody with a Chinese interest, Russian interest, or any non-NATO country. Yes, we have a lot of foreign investors and foreign clients. They're Western EU for the most part.
Dutch, German.
Yep. Here's the debt to equity, debt to asset ratio, and then this debt repayment. So before you get all hyped up that debt's at the all-time high, which it is, farmland debt is at the all-time high, real, inflation adjusted. But debt to equity, debt to asset ratios are extremely healthy because your asset values are today. And keep in mind, 84% of the farms in Iowa have no mortgage, so that you're not going to change that real quick. And then here's farm repayment. Of course, 2022 was the best, Damian, the best farm income year since 1973, farmland or inflation adjusted.
Did we hit about
last year was pretty
Howard, 186 billion, was it?
Yes, 184, something like that.
184 billion of farm income last year. So and this is no offense, but I told a couple of my banker audiences, if you have clients that are defaulting now, get rid of them as clients, because if you're not making it in this gravy train, you're not going to make it when things get tight. And that's really what your charges shows. Our repayment, we've got some debt, but it's against heavily priced assets, and the payment problems aren't there.
Exactly.
Next question, Joe Van Meter, my buddy, who's also a Purdue guy. Howard and Damian, thank you for the great info. Appreciate your perspective on how successful owners diversify their operations to maximize long-term gains across various income sources: crop, livestock, hunting and recreation, timber, CRP, equip acreage, depending on the type and size of the acreage. And for perspective, Joe's got land in southern Ohio, and it's significant acreage, about it's significant, and also has a significant amount that's in the timber, and a couple of acres that are in CRP. And then they have a landlord, they have a tenant operator.
Yeah, I think that there are more and more buyers that really appreciate that uniqueness. And one of the things we do when we manage a farm operation is we try to maximize every acre of that farm. If it's cropland, you try to maximize the cropland. So that's drainage, that's irrigation, that's fertility, that's weed control. If it's woodlands, we don't just clear woodlands. We look at that and say, how can we maximize the value of that timber? So it's timber stand improvement, or maybe it's tree planting, or maybe it's hunting revenue. So we look at diversified income streams as we look at the hunting or the timber aspect, the recreational aspect. And then you get into the buildings. Gosh, there are so many different barns being used as wedding venues. Now, I'm not suggesting that we're going to manage a farm and create a wedding venue, but there are a lot of folks that look at that, the unique aspects of country living, and there are a lot of opportunities. And then you've got the USDA programs that if you decide you want to do a timber planting or you want to control erosion, or maybe you want to go to some kind of a program where it's more sustainable, he's exactly right. You can utilize CRP, wetlands, reserve. You can go into waterways and a lot of different projects that you can get cost share for, depending on your income qualifications. So a lot of opportunities exist out there to make your property the best it can be. And that's our goal when we manage a property, is try to maximize that within the owner's goals and objectives.
Howard, I have a question, and then we're going to wrap it up. We're here at the hour and 17 mark, which has flown by because there's really good interaction. I really like all the questions, some very smart questions and different takes on stuff. The Farm Bill is allegedly in process, although they're also figuring out whether we're going to even be able to fund the government here by the end of this week. It's my assertion or belief that we're going to have a Farm Bill, maybe not this one, but for sure future ones, that if you don't do certain things on your farm property, you're not ineligible for crop insurance and some of the programs that the tenants or the operator really needs. And I'm talking about water protection. I'm talking about, buffers along creeks. I'm talking about erosion control, maybe even cover crops. I really believe that those things are going to end up being, you have no choice but to do certain things that are environmental to be eligible for USDA programs. That's where I think things are going, just based on the tea leaves that I'm reading. But ultimately, won't those prop up land values? Because the USDA is probably going to use a carrot approach, not a stick approach, and say, you're going to do these things, but we're also going to toss you money for them. You're going to protect waterways, but in other words, it's like CRP, the next level. I think that's where things are going. Do you agree with me? And B, wouldn't that be price positive?
So I've been working on a project for, 3 years now, and it's all around sustainable practices. And I think it's an opportunity for landowners being farmers and absentee landowners. But anybody who owns a farm, I think you're exactly right, Damian. I think that this more sustainable initiative continues to move forward and expand. And it's not going to be a stick, it's going to be a carrot. There's going to be some subsidies that enable you to be able to do some things. But there will also be if you want to participate in crop insurance, you kind of got to do these practices. And this moldboard plow and allowing willy-nilly wind and water erosion is probably not going to pass. I'm not being critical if you choose to farm that way, but I'm just saying I'm agreeing with Damian. I think going forward, you're going to see more of this sustainable initiative. You go to the EU, and sometimes what the EU does gets over to the United States eventually. There's a big initiative around this. So I think there's going to be more of that, and there's going to be more opportunities for people to grow crops sustainably and get paid for doing it. And that's going to be the key, because when that happens and you can earn more because you're doing it sustainably, then that will provide immediate income enhancement.
Yeah.
And oh, by the way, 10 years later, your farm's going to be a better farm. To your point, Damian. You're going to hold your soil in place. You're going to have less erosion. You're going to have higher organic matter, which means your water holding capacity goes up and your fertilizer is more available. And all of a sudden, it's a more productive asset, which if it's more productive and it's been farmed in a way that the reputation of the farm is enhanced, that probably translates to more value.
We just talked about what reputation adds. And by the way, I conditionally, I don't think Mr. Halderman and I, either of us are sitting here applauding more USDA involvement on America's farms, but we're just talking about what we see coming, right?
Exactly.
I think that's our last question from the audience. Alex says, "Having to run. Thank you for putting this on." So we got some really nice comments for people. Appreciate your expertise and stuff. We'll get to those. Here's my last question. We opened the thing, Howard, by saying, "Is ag real estate at a peak?" And we've got a lot of different discussions of why it is and the other factors impacting it and all those kinds of things. We didn't get too heavily into trade. We got into a lot of things. But let's ask you your question. This is what I always do when people present me with a business situation. If I gave you $1 million tomorrow, would you invest it in farmland in the next 30 days? And I'm asking you.
I would.
Okay. And what would be your first off, it's what you know, and it's obviously your business, but what things do you know that maybe I don't know, or the audience is thinking, if I dropped $1 million to any one of these, I'm looking at Gene Marshall and Matt Starr and Rusty, and I'm looking at the names on here. If I dropped $1 million in their hands, why should they consider investing, even if we're at a peak and we think there's a 10% correction coming?
At the end of the day, there are more mouths to feed, and we're going to 9 billion on the planet, and there is going to be greater food demand. And in the United States, you have the safest political structure. May not always feel like it, but it's look at Russia, Ukraine. Why not invest in Ukraine versus the United States? You've had your answer, right? So I think that you can invest in a safe, sustainable, and the best capitalized in the world industry right here in the Midwest. And oh, by the way, the climate tends to provide enough rain on an annual basis to grow a really good crop. In spite of what we talked about earlier with the variability in the weather, it's going to be an above average crop in Indiana this year. And you combine that with good markets and just tremendous opportunities to feed the world. I think there will be more opportunities in agriculture in the future, be it a little bit of solar or renewable energy or locally grown or sustainably grown or new crop types. And where do those companies bring those crop types first? They bring it to the United States because we have patent protection and we have the producers with the technology to produce it in a very high quality way. And so that's why I've always been bullish agriculture, and especially in the United States. So, give me $1 million. Yes, I know it. That's probably where I'm going to invest it. Most of the people on this know agriculture, know farmland, and would do the same. And I think there will be opportunities because we see this at every auction. This happened last week at the Bingham sale. You look back and you say, gosh, that track 10 seemed cheap. That would have been a good place to put some money. Mm-hmm. And I think those opportunities are going to be a little more prevalent than what we've seen the last couple of years where everything sold at a premium. So I think there'll be some nice buying opportunities in the next 12 months that create a long-term opportunity for you and your family.
Well, we're going to leave it right there. What a great topic that was. Is agricultural real estate at a peak? Howard and I had a very lively and interactive discussion with the audience of that webinar. And again, I thought it was so important information that we can share with you here on the Business of Agriculture podcast. So till next time, thanks a lot for being here. Damian Mason. Well, that concludes another fantastic episode of the Business of Agriculture. This episode was brought to you by Pattern Ag. Everybody in agriculture understands the importance of soil health. We also keep an eye on our soil better than we ever did through advanced soil testing. But what if there was a company that provided predictive analytics, not just checking out nutrients and all the elements that are in there, but also could tell you the degree of risk you face with disease and pest pressure? That's right, Pattern Ag can do that. They actually can tell you, hey, you're going to have a real issue here. You can proactively treat for corn rootworm or cyst nematode or sudden death syndrome before the problem actually starts costing you yield. Go to pattern.ag, that's www.pattern.ag, to find the nearest rep that can help you start doing better for your soil.